Hi, Fidel.
Hi Dana,
How
how
are
are you doing?
you?
I'm good, and you?
Good. We're excited to have you today as we start our conversation today on private equity. Maybe you can tell us more about yourself and
Yeah,
a bit about the conversation we're going to have today.
sure. Thank you very much, Dan, for having me. So my name is Fidel Mwaki. I'm a partner at FMC Advocates. We're a law firm based in Westlands. A lot of the work that I do includes advising investors on investments into Kenya, especially investors who are looking to buy into small and medium-sized enterprises that are emerging into the economy. So today, one of the topics, or the topic that we're going to be discussing is to do with venture capital, and this really relates to how investors can, support emerging businesses as they start to come into the market. So I look forward to a great conversation.
Okay. Thanks. Thank you, Fidel. That's quite interesting how you deal with investors and you give them advice. Maybe I can just ask from your experience, how do innovative startup businesses start and grow? Maybe just to start from the beginning.
Yeah,
Yeah.
yeah. So I think we all understand in Kenya how businesses grow. Generally, you would start with an idea. There's this concept of startup businesses that has come up, over time. So startup businesses tend to be very innovative. Yeah. So when you hear the word startup, start thinking about innovation. A business that is bringing in a new technology, new ideas. So ideally, they would start with an idea, and that idea may be a technological innovation that they're bringing into the market. So once they have that idea, as a founder of such a business, you're going to then set it up. You're going to do your usual, set up a company in Kenya, set it up, incorporate it as a company or as a partnership, and then from there you start to actually trade as a business. Over time, your business is actually going to start to emerge, assuming that it's well run. It's you're making a bit of profit. So when it starts to emerge, it's actually starting to perform better, yeah, and it's starting to actually gain more profits as opposed to how much cost it is incurring as a business. And then from there, the business actually has an opportunity to scale. So scaling means it now is able to grow exponentially much larger than it is currently. So generally, when it comes to innovative startups, there's that kind of, you know, a growth pattern that is there for such businesses. And, in the Kenyan economy, that is what we're seeing at the moment.
Okay. I think it's quite interesting how you distinguished a startup from a business.
Yeah,
And I didn't know before that, for it to qualify as a startup, it must have the innovative aspect.
yeah.
Maybe if we can just look at, given the growth path for such businesses, how do you secure funding? Because like you mentioned, with startups, you have an innovative idea, but sometimes you need to now expand or
Yeah,
reach new markets.
yeah.
How do you, access such funding?
So remember we talked about initially you have your idea and you're starting the business. So a lot of businesses when they start, they usually get, funding from maybe friends, from family who will just pump a little money into your business so that you can get off the ground. So as your business starts to grow and emerge, of course, you can no longer rely on these kinds of people to assist you. They were there at the beginning, but they can't now take you to the path that you want to grow. So you now start looking at alternative sources. So maybe you'll go to the bank and try and get a loan, or you look at alternative funding. So one of the alternative modes of funding that are available are what we call private capital. And this is capital really from private individuals who have, means to invest in startups, especially those ones, as we mentioned, have certain innovative ideas and things that they want to push into the market. So as a startup, you have that path whereby you start with a small amount from certain friends, family, and then you start to grow into these other areas like bank finance and then private capital as well. Yeah. So those are that's the kind of funding journey that you may experience as a startup.
Okay, that's
Mm,
quite interesting. I'm a bit curious of the last term that you've used just now,
mm,
private capital.
mm.
Maybe you can expound a bit more on private capital.
Yeah.
Yeah.
Yeah. Private capital can be a bit of an obscure term if you're not used to it, because you may start wondering, okay, so what is the bank's kind of capital? Is it private capital? Is it public capital? Then you also start to hear of things like, when a business goes public, what does that mean? With private capital, essentially you're looking for investors, private investors who are interested in investing in such businesses. So when you're looking at private capital, you're looking at people who maybe they're based in certain jurisdictions and they like to put in money in other jurisdictions, and they look for startups that are innovative, that are looking to expand. And such capital is usually at, at high value kind of sums. So looking at $1 million, $10 million, $50 million and above kind of money. So with private capital, there are two types. There is venture capital, which is what we're discussing today, and there's what's called private equity. So the distinction between the two is quite unique in that with venture capital, a venture capital, kind of funding is focused more on startups and emerging businesses. So they're looking to invest in a business that is actually starting up, while private equity is more looking at established businesses that now need to actually be given funding for certain new products that they're setting up in the market. So with venture capitalists or venture capital, the people who are putting in that capital are not looking necessarily to come in and take over the business. They're just coming in to support the business with some finance so that it can then move from the small scale it is to now start to emerge and scale up. While with private equity, the business is already big. Maybe it's not performing so well. Maybe it needs some additional capital because it wants to introduce new products into the market, or it wants to expand into other markets as well. So private equity is really looking to come in to deal with the business and try to help improve its productivity where it's already in an established market. So that's essentially the difference.
Okay. That's quite interesting, especially, as we speak about venture capital.
Mm.
Um, from your experience or dealing with, with private within the space of private equity, who are the key players in the venture capital space, and
Yeah.
what are the roles, and what kind of expertise do they bring to a particular transaction?
Okay. So generally, I would say there are three main actors in what we call a venture capital transaction. The first one, of course, is the entrepreneur who has the business that needs that funding. The entrepreneur generally is any small business that has an innovative aspect to it. It's probably run, some of them, many of these small businesses are probably family led businesses. So you have your individual shareholder or two shareholders and a couple of directors. And that essentially is how the business is. The other actor in this is what we call an angel investor or a venture capitalist. So essentially, this is the person with the money, yeah, the person who has the funds and they're looking to invest in these kinds of businesses. So a typical venture capitalist may be looking at a business in Kenya, they may be looking at a business in Zambia, a business in Tanzania, and they're looking to see if they can invest in those businesses. Maybe they're all similar, maybe they're in different sectors, but essentially they have the funds to actually come in and bring in to support that venture. And then the third actor are usually what are called venture capitalist funds or farms. So these are actually professional bodies that actually manage funds for the venture capitalists themselves, the angel investors. So the venture capital farms usually are very well professionally managed. They have experienced professionals who understand the local market, they understand the business that the investor wants to invest in, and they're able to give advice, expert advice on whether this is a good investment or not. And part of what they'll do is, and I think we'll discuss it later, is things to do with like due diligence, just due diligence on these entities as they are as the person which wants to understand what's happening within those businesses. So the professionals are critical. In addition to those professionals, you'll find the lawyers, accountants, auditors also involved. The main professionals that are there are the venture.
Okay.
Mm.
I think it's very interesting and crucial to understand the actors to this particular transaction,
Mm.
and even how you've, I think, detailed it out.
Mm.
I think the question I have, or what I'm curious to find out is, is there a specific lifetime
Mm.
or period for which a venture capital deal transaction should take, or it's up to the actors to decide how long they want to be in this particular transaction?
Mm. Well, typically a venture capital deal will follow a standard form of structure and a lifetime. So initially, you as the, of course, you as the person who has the innovation or innovative product, you want to ensure that the information that you're supplying to a venture capitalist is secure and they're not going to use it to, maybe set up their own business somewhere else. So you're looking to, of course, sign an NDA, a non-disclosure agreement with them to ensure that they, keep your information secure and they don't disclose it during the term of this arrangement. You may have what's called a term sheet. The term sheet is just a document that sets out like the commercial terms of the entire transaction so that all parties understand. So if I'm going to put in money into this business, what are the terms of this funding? What are your obligations? What are my obligations as the investor? So those are the typical things that we put into the term sheet. Even the amount of funding that you're willing to put in, and at what stage that funding would actually be put in. Then you start looking at what we call the due diligence process. So the due diligence process really is where the investor is now looking to check up on your company and get information and understand how your business works. Are there any risks in investing in this business? Typically, some of the due diligence will involve reviewing contracts, if you have property, doing searches on such property, doing due diligence on the owners of the company. Are they people that they want to do business with going forward? So this due diligence aspect is also critical for investors looking to come in and put money as venture capitalists. And then, of course, as lawyers, we get involved through the legal documentation and preparing whether it's asset purchase, share purchase agreements, which then kind of now, solidify the arrangement. Okay, so we've discussed, legal documentation and how important it is for investors and entrepreneurs to actually sign the proper legal documentation for the transaction. Allied to that is also just understanding, what that legal documentation covers. So there are various what we call funding stages. There may be a first round of funding or a second round of funding, and each funding round basically relates to a certain transaction. So the first funding round may allow funding for specific, um, marketing, proposal for that, innovative product. While the second round of funding may lead to, increasing the capacity of the business to actually roll out the product into the market. So each of these funding stages is crucial for the business to actually, grow and expand. And then finally, the lifetime of a venture capital transaction will involve, the company actually going public. So assuming all goes well and the funding stages allow the company to emerge and scale, as we discussed earlier, this then leads this business to be able to offer its shares to the public and ultimately allow the investors to exit the company at some point in the future, having made some profit.
Okay. Thank you, Fidel. Would you say that right now there are some, or rather, what would you say are the popular areas for investment by capital venture firms?
Yeah. So I think there are a few areas which are interesting. There's a lot of innovation happening in the technological sector, in social media. So we're seeing a lot of investment by, private investors and venture capital firms in these sectors. Also health and medical, because a lot of it is going online. So many businesses that are going online, such as the medical sector. We're seeing a lot of, e-learning even with schools. So these are areas as well that allow for venture capitals to come in and actually invest and help these businesses scale. So I think any business that has an innovative aspect to it is ripe for venture capitalists to come in and invest.
Okay. Maybe even top of my mind, I think I can just add businesses that are, allied to the climate change initiatives.
Yeah. Climate change and energy as well.
Yeah.
So these are all major areas for investment.
Okay. So, what should one consider when seeking venture capital for businesses, for their business rather?
So I think for an owner or entrepreneur, number one, of course, your business should be emerging. Of course, it's a startup, but it has potential to start emerging as a business. And when we say emerging, I think we discussed it earlier. It's now looking at potential to grow out of where it is currently and scale quite fast. So again, a high potential for growth is another area. So even the guys who are doing due diligence, the investors and the venture capital firms, That's some of the things they're going to be looking. They're going to be looking at your numbers, looking at your accounts to see whether there is a potential for you to actually grow and expand. I think also being open to investment. You'll find a lot of these startup companies, as you said, they're family businesses, and now starting to think about introducing outside investors into your business. It's a big step for many businesses. So as a business, it's important that you as a founder are also open to this kind of investment. And finally, I think the regulatory environment is critical for the investor, critical for the entrepreneur. So the laws around the investment, are they uh, conducive or provide a conducive environment for investment or for investment by venture capitalists? So I think those are the four critical areas that entrepreneurs should consider.
Oh, okay, thank you, Fidel, for sharing with us those great insights on private equity. As we come to an end, what are your key takeaways when it comes to private equity, and what should each stakeholder keep an eye out for?
Yeah. So I think definitely a market like Kenya's developing economy, where it's starting to emerging in the world, is ripe for venture capital investment. So I think if you're a business that is setting up there, think about looking for venture capital investment, because it can help your business scale and grow and reach new markets, not just locally but internationally. For actors within the space, such as the venture capitalists, there's a lot of opportunity in Kenya, a lot of opportunity in Africa, really, for such businesses to grow. And also finally for the actors, the professionals, the work is there. For lawyers, there's a lot happening, and understanding the legal frameworks is critical as well. So I think for everybody there is opportunities and there is a chance for growth in this area going forward.
Thank you, Fidel, for joining us. We look to hear from you more and more on this particular channel.
Thank you, Dan.